Hey, what's up? It's Ben here. The stock market is crazy. There are companies that are taking a huge beating, and there are some that are thriving even in tough times. So today, I'm going to cover 5 best growth stocks to consider for the coming future. I put quite some time into it, so hope you all enjoy. So let's get into it. Number 1, Zillow, ticker symbol ZG. For those of you who have searched for houses online or look for a place to rent, you might have used Zillow at least once. It's a pretty useful tool when it comes to doing some real estate shopping. They have over 218 million monthly users, and they are the leader in online real estate. So basically, they're like a Google search, but for real estate search instead. The reason why Zillow has the potential to grow even bigger is because they are adopting a full service platform, from buying to selling to renting to financing and even remodeling. On top of that, they can even buy your house to make it super stress-free without a crazy wait time or the need to do any repairs. They want to be the leader of it all, and they can do it because they have the data to do so. The company wants to make the real estate transaction as simple as buying or selling a car without leaving its platform. Currently, Zillow is trading around $79.82 with a market cap that's over $18 billion. Their annual revenues are growing every single year, but they aren't profitable just yet because they're still in the early stages of their transformation. But they have been beating their earnings for these past quarters. Analyst recommendation rating is a 2.4, close to a buy, and its price target is at $82.84. If Zillow can still grow during this pandemic, they'll for sure be able to grow even after the pandemic. The CEO of Zillow, Richard Barton, even believes that because people can work remotely now, they will like more space. Thus, they don't have to live in tight urban cities or commute to work. Instead, venture out away from the cities for more space and privacy. Therefore, you can see more new homes being built outside of major cities. Number 2, Adobe, ticker symbol ADBE. I would say if you used a computer in the past, you've probably used some of their softwares without even knowing it. They're basically a software company, but people mainly know it's Creative Cloud. That is a subscription-based service that includes Photoshop, Lightroom, Premiere Pro, and many other Adobe products that help creators produce various digital media. And if you didn't know, they also have a publishing segment that offers products and services to individual customers and businesses. Currently, they are trading around $451.58. Its market cap is over $216 billion. Its PE ratio is at 59.58, and its earnings per share is at $7.58. Looking at the charts, its 5-year had a really good run up, hitting all-time highs every single year. Even with this pandemic, they are still thriving because most of their products and services are online. People aren't just going to stop using their products and services. In fact, more people are going to continue using it because people are staying home more. Their profit margin is 30.71% and their return on equity is 35.55%. They also have a quarterly revenue growth of 14%. Earnings growth is important when you want to check out if a stock is growing, and looking at its earnings estimates, it looks like they're going to grow from a 9.7 to 11.1. In addition to that, they have been beating their earnings every quarter so far. And as far as the revenue goes, it looks like they may go up as well from 12.7 to 14.6 billion for the next year. A positive cash flow is also crucial for a company's growth, and looking at its cash flow, they are indeed doing good. Number 3, Lowe's companies, ticker symbol LOW. If you've worked in construction, you've most likely have heard of this company before. They are a home improvement retailer mainly in the United States, Canada, and Mexico. If you do some sort of remodeling or construction and you're looking for some materials, their store mostly will have the basic products for you. During the pandemic, sales have been increasing. I guess people are staying at home more and doing more home improvements at home. Granted, I'm guilty of it myself. Sometimes I will have to wait in line just to get some basic supplies from them. Whether there is a pandemic or no pandemic, real estate is just popping in general, and this company has been growing in the past few years. It's currently trading around $158.41. Its market cap is over $119 billion. Its PE ratio is 26.69, and its earning per share is $5.94. And they have a small dividend yield of 1.48%. Looking at the chart, they have an upward trend. The profit margin is 6.17%, and the return on equity is substantially high at 184.65%. In addition to that, their quarterly revenue growth is 10.9%. They have been beating their quarterly earnings so far, and we'll have to see if they'll beat it again for this coming quarter. Analyst gives it a 1.8 between a strong buy and a buy, which is good, and the analyst price target is at $162.60, but currently it's at $159.41. Although Lowe's financials look good and the projected earnings and revenues are all positive, this is going to be tied with the real estate and housing market. As long as real estate is doing good and there's need for more construction, which I believe there will, this stock will continue to go up. Number 4, Lemonade, ticker symbol LMND. Now, this is not an actual lemonade company. They are an insurance company that offers homeowners, renters, and pet health insurance. Currently, they're mostly catering to younger population or the millennials because they simply want to simplify the insurance process without having their users jump too many hoops. Plus, it only takes a few minutes to sign up. Currently, most of their customers are based in the United States and in Europe, and they have so much room to grow, such as tapping into auto insurance, health insurance, and even life insurance. They use artificial intelligence to get you affordable quotes digitally without using an actual person, thus offering a cheaper insurance premium when you compare it to your traditional insurance companies. So what that means is that the more users they get, the better their artificial intelligence becomes, because the more data it has, the better it becomes at giving out affordable quotes and also helping the company make money. Initially, when they started, they lost a ton of money because the AI was giving really cheap quotes and their claim was higher than the premiums received. And they knew that because the more users and data they acquire, the better it becomes at pricing the quotes later on in the future. But besides making money, they also donate part of your premium to a nonprofit organization of your choice if you haven't filed a claim in a while. They quote unquote even say, "We treat the premiums you pay as if it's your money, not ours." So that's pretty neat. What's also neat is their approval process for claims is quicker and faster than other brand name insurance companies. Literally, you can get paid within minutes instead of waiting for days like some insurance companies. And because of the simplicity and how efficient the setup is, this company has a huge potential to grow even bigger in the coming years. Currently, it's trading around $61.48 with a market cap that's a little over $3 billion. And because they recently IPO, you might see a huge fluctuation in their stock price. It's normal to see that, so if you also think it's going to be a long-term play, dollar cost averaging it might be a good play. Number 5, Tesla, ticker symbol TSLA. You don't have to be an investor to know about Tesla, since almost everyone talks about it, from investors to non-investors. To keep it short, they basically sell electric cars and generate and stores electricity. They don't do much marketing and doesn't even advertise at all. Most of the marketing is done basically word of mouth or from Elon Musk, the CEO himself. And just these past couple of years, Tesla has built a cult-like following. It's because the product they offer is actually innovative. They're currently trading around $1,835.64 with a market cap that's over $342 billion. And soon they're going to do a 5-for-1 stock split, so the price per share will be smaller and more affordable to the general public. But here's why Tesla will continue to grow in the future. First, they have the Chinese EV market. They have a gigafactory in Shanghai for a reason, and it's to pump more vehicles into the market, and it's been a hit ever since they opened. Second, Tesla insurance. Tesla has a lot of data on its users already, so implementing it nationwide wouldn't be a problem since it's already happening in California. Then it's like a cash cow with a stable income coming in. They can undercut traditional insurance companies because they'll be able to get more accurate projected costs of what the future damages will be like for its users. Third, Tesla Solar. They're uniquely positioned here since they sell electric cars. They can also sell solar panels or just seamlessly opt into their monthly subscription service for those who don't want to buy it outright. They'll come install it for no additional upfront costs, and you can cancel anytime. That's pretty amazing. Fourth, they have self-driving. This could be a couple years from now, but when it does become a thing, you bet the company will take off. Self-driving taxi will be the norm, and Lyft and Uber might go out of business if this is adopted. Traveling would totally change because of this, and because of all these reasons, I'm extremely bullish on Tesla stock. So there you have it, 5 potential high growth stocks for the future. Again, this is based off of my opinion. Please don't use this to invest, but rather a starting point for you to further look into these companies. I hope you guys like this. If so, please give it this a like and maybe consider subscribing for more updates like these. I'll catch y'all later.